Hi guys, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter, coming to you from down here in Central Florida, where it's just a nice warm day. We're all watching some storms form out in the tropics that might be headed our way next week. That could be interesting. We'll try to do a video while the storm's going on, if it does in fact make it all the way here to Orlando. Now, this is our regular weekly video, but I really thought about sending out another really sarcastic special market in turmoil video, because, as you know, I've signed up for the free part of a lot of newsletter services, mostly to see what they're doing marketing wise, so I don't do that because I find most of the marketing techniques that are used in the business to be, let's be honest, a little bit offensive. I try not to do the hardcore sales page, but I got no less than 7 special market update videos this past weekend telling me how to deal with this looming crisis and massive changes in the market. And I thought about doing one of those, but really, what was I going to tell you to do? Take a walk, spend some time with your family, maybe go out and get yourself a big green egg and, cook some pork low and slow for the weekend, read a book, watch a baseball game. If you lost any sleep this past weekend worrying about the stock market, one of two things is true. You do not have a defined investment philosophy, or you had entirely too much leverage in your portfolio. If you were a deep value or a committed bank stock investor, and I am certainly both of those, you came in to Monday morning with a ton of cash because in your deep value portfolio, and in the bank side of it, you frankly just weren't that concerned because the broad market activity was going to have very little impact on what happens in your portfolio of small community banks. So you were either ready, had a philosophy, knew what you were going to do, were really excited about the possibility of prices going down and creating bargain issues, or you were not prepared. You're one of those folks that chases the hot stock of the day and, flits from hither and yon and is trying to be the next Jesse Livermore, and you ended up with a very sleepless weekend. And I'm willing to bet that you lost money on both sides of the deal Monday and Tuesday, because that's just generally what happens when you don't have a guiding philosophy and a long-term game plan for approaching the stock market. So now, anyway, we had some orders in Monday morning. We could see it was going to drop between 9 and 9:35. We got filled on. I probably had 25 orders in, guys. I got filled on a handful, a couple. I bought some new shares in a energy-related closed-end fund because, like the private equity guy said in the last round of conference calls, it may get weaker. In fact, Josh Harris of Apollo told us, "Hey, this is going to get worse before it gets better." But long term, we feel pretty confident that over that 5 to 10 year time frame that we like to deal in, that there will be an eventual recovery in oil. So we bought a heavily discounted closed-end fund that invests in oil blue chips, and I felt pretty good about that. By the way, Monday morning, Chevron traded under book value for the first time in at least the last 15 years, according to my database and a quick check in Value Line. So energy stocks are getting extraordinarily cheap. We're just looking to get that safety factor in there. That's a bit of an issue because fundamentals have deteriorated badly for a lot of these oil companies. Now, one thing I want you to keep in mind as we go through the next few days. Now, today's reversal, I'm not a technician, but today's reversal was ugly. We were up 500. I think we closed up down 200 and some change. I'm looking over at the TV to catch the exact number as it flashes by over there. That's ugly. The technical guys that I know tell me that that's just not a great idea. Down 25.60 on the S&P 500 after being up quite a bit during the course of the day. That's not a good thing. That's a buyer's capitulation. It's just like, hell with it, we're done. We're not buying anything else here. And the sellers absolutely overwhelmed them. And it started late in the day, which does give you cause to believe that this could be people lightening up for A, margin calls, and B, fund redemptions, and that can continue to go on. We were ready for this. Okay, China slowdown was one of the things that we addressed as a major concern, along with Vladimir Putin, violence in the Middle East, and of course continuing declines in oil prices. And of course the goofballs in Greece always are hanging around waiting to disrupt markets here. We've got over 50% cash even after those few small buys on Monday morning in the deep value portfolio. It's about 45% in international deep value. we're prepared. Frankly, we hope prices continue to decline. But keep in mind, just because you're seeing these big triple-digit numbers on the television set does not mean that this is a buying opportunity yet. We ran the screens every day. I'll run them again first thing in the morning, but we're not getting a lot of new names just yet. We started from way up here, okay, a 6.5 year bull market. The market cap to GDP is up, way over 2007 levels. The Schiller P is like 26 or some crazy thing. So for normalcy to return, we have a ways to go. So don't get too excited and think that you need to jump right in there. Focus on the fundamentals, the price to book value, the enterprise value to EBIT ratio, and the key financial safety measures. Now, I use my fundamental credit model, but if you're playing along at home, you can replicate a lot of that by paying attention to Piotrowski F scores and Altman Z scores in the stocks that you buy. Wait for stocks to come to you. Don't just assume because prices are falling that they're necessarily a bargain. You can still overpay on a day when the market's down 1,100 points, and many people found that out on Monday. So now, speaking about oil a little bit, I wrote this today on Real Money. The real question in oil right now is how much time you have and how much pain can you take, because it is a long-term thing. We are looking at oil in terms of 5 to 10 years. We're not looking at it as a 3-month trade. By the way, doing some research, what the average holding period on a stock is right now for individual investors in the United States? It's about 17 weeks. That's disgusting. The average private equity holding period is about 5.5 years. So we need to start thinking more like those folks and less like the day traders and Jesse Livermore wannabes. But anyway, looking at oil, it could be painful. In fact of the matter is, a lot of the oil-producing companies or countries around the world have break-even per barrel production costs. I think the lowest in the world are the Saudis. It's $27 a barrel, so they can go a little bit lower. Now, truth be told, they need $87 a barrel or somewhere thereabouts to balance their national budget. But for now, as they play this market share game, they are completely willing to continue to dip into their dollar reserves to keep the bills paid and keep the population happy while they try to force the U.S. shale drillers to cut back production. That's not going to happen just yet because these guys were hedged coming in. They're hedged back up at $90. An enormous percentage of first and second quarter earnings for the U.S. shale oil companies was, guess what? Hedges paying off. Now, the second half of the year, we're going to start to see some of these hedges roll off, and they pretty much all roll off by about this time next year. And at that point, when the hedges are off and you can't forward sell your oil at 90, you can only get a long-term hedge at 30 or 35, then we got a different game. Now you got to look at the well and say, what are the real economics of this well? Can I afford to keep it running? Can I keep paying the interest on all this debt that I owe, or is it time to just shut this thing down, hire my bankruptcy attorney and go to court and wait for the next boom where I can borrow a whole bunch more money and dig for some more oil, because that's sort of how this thing works. The same guys play the same game over and over and over again. It's been that way in every oil boom bust cycle pretty much since time began. This was not going to be any different. They just dug for the oil in a different manner using the shale drilling techniques, and they borrowed a lot more money at a lot lower cost. But so when the hedges roll off, we'll see U.S. production start to shut down. That will force global prices a little bit higher. In the short run, there's all sorts of things that could disrupt the oil markets and create higher prices. We don't have those factored in to our expectations. They could happen. If they happen, we won't be happy about it because it'll be some sort of violent confrontation in the oil patches, but we will react accordingly and sell if oil stocks should shoot up dramatically over the short run. So we'll see how that plays, but we're looking out 2020, 2025. That's what we're thinking about when we're buying oil stocks. Bought a bunch of oil back in December, as you might recall. We bought a bunch of oil names. We sold some a couple months later because we realized that our fundamental model hadn't accounted for lower oil prices on the credit side, but we still have most of them left. We have been beaten up like Ronda Rousey's last several opponents, but we remain confident that these companies are strong enough to survive until at some point in the future they do thrive, and we earn many times our original purchase price on these stocks. And we bought a closed-end fund that specializes in oil blue chips, looking really hard at some of the closed-end funds that own infrastructure assets, because the pipelines, the storage facilities, they're going to be there. They're going to get used. They may make less money. Some of them may have to cut their dividends, but they're going to be around. And again, the 10-year price performance could actually be quite dramatic. And if we can buy those in a closed-end fund at a 15 or 20% discount, I saw one the other night at a 22% discount to the underlying current net asset value, well, then we can gain even a little better edge on that anticipated strong long-term performance. So that's kind of where our mind is at with energy. We're interested. We're moving very slow. We're aware that this could get a lot more painful before it gets a lot better. We have plenty on the books, and we're looking forward to adding cautiously to those that are not only cheap but safe, using our very much enhanced and much stronger credit methods than we used last year when we first ventured into the oil field. Life is a learning process. This one just hurt a little bit more than most. So let's combine two of our favorite topics today, oil and banks. We've been looking at Texas banks for a while now, with envy and awe. They really never got down to anywhere near where we wanted to buy them. They didn't get down to those nice discounts to book value. They didn't even really get real cheap in 2008 and 2009. But guess what? The decline in energy has folks selling Texas banks. And we got a lot of these banks now. They're not below book yet, but they're 1.2, 1.3 times book value, and they're falling like a rock. So we're getting real interested in, oh my goodness, why would I be interested in a Texas bank? It's going to crush them. Yeah, folks, Texas, as my wife will tell you, is a big, big state. She is from San Antonio. It's one of my favorite things to do is listen to her sisters and her phone call once football season starts up, because one of them's an Aggie, one of them's a Longhorn, and it can get a little heated and interesting from time to time when football is involved. Football, of course, being the state religion in the great state of Texas. But they've got a strong agricultural economy. They've got tech and biotech in and around the Austin area. There's aerospace, just looking at some of my notes. Healthcare plays a big part, big tourist industry. And Texas, keep in mind, has a huge military presence with two of the largest bases in the country located within the confines of the state of Texas. And all those thousands of military personnel spend quite a bit of money within the borders of the state. So oil hurts in and around Houston, can get real interesting when oil prices collapse, but it will recover just as oil recovers. So if some of these banks drop down to that 80-85% of book value level that we love so much, and the balance sheets aren't stretched too much by oil-related lending, we're going to be real interested and real excited about building a portfolio of banks that are deep in the heart of Texas. Sorry, I couldn't resist that one. So anyway, here's where we are. We had a nasty-looking reversal this afternoon, and again, I'm not a technician. Don't play one on TV. But my friends that are technicians tell me this is bothersome, the way we sold off, and could, in fact, foretell more aggressive selling. What we do know, China is slowing. They're desperately injecting money into their stock market to try to prop up prices, and it's not working. Here in the U.S., revenue performance of S&P 500 companies was dismal. What earnings growth that we saw in this quarter was entirely the result. We'll say almost entirely the result, to keep lawyers and anybody else out there happy, of financial engineering like stock buybacks and cost cutting. And a lot of these stock buybacks, folks, were done with borrowed money at very inflated multiples of earnings before interest and taxes, accounting earnings, and book value. So it was really a destructive use of capital, but it's been a popular way to keep your stock price pumped up. Personally, I think any board that votes to buy back stock at more than, let's say, 2 times book value and 15 times earnings should be fired for cause, for destruction of shareholder capital. But that's just one man's opinion. So we don't know what's going to happen. It could get quite sloppy. It could get quite messy. We are big advocates and fans of Hetty Green and Mr. Womack, but remember something. Just because prices are falling does not mean they are cheap. Okay, when 2008 started, it took well in towards the end of the year, like December, before we started seeing prices at levels where we were like, oh boy, put on the party hats, we're going to load them up here. And as we fell further through the first quarter of 2009, it was March 6, 2009, when I wrote something to the effect of feeling like I'm going to use polite words, a kid in a candy store, because there was just cheapness everywhere. You could just buy anything, and odds are it was cheap. So all we had to do was focus on the credit side, and it worked out incredibly well over the next 3 or 4 years for us. So we hope we get there. We're not going to predict it. I think the conditions are certainly in place for a sustained sell-off. Again, starting from a high level, very weak economic growth. The Fed is absolutely in a box because forget raising interest rates. They got to figure out what they're going to do if this market decline continues to get ugly, because there's not many bullets left in the gun. So again, Janet Yellen, God bless her, has the worst job in the entire United States of America, and whatever they pay her, it's not enough, because we've got an impossible situation that could be developing, and it's going to be very difficult for her to deal with it. So let your philosophy guide you. Pay attention to safe and cheap. Do not panic. If you've got safe and cheap stocks in your portfolio that are falling in value, do not rush and sell if they're still financially strong. As Hunter Thompson said, buy the ticket, take the ride. We're in there. If they get cheap enough, buy a little bit more, but do not get panicked here. Do not rush to invest the cash. Do not rush to invest what you currently own. The future is impossible to predict. We're coming into this incredibly well positioned. So we've got lots of cash. We're ready to buy. We have some safe and cheap stocks currently in the books. Maybe we want to add to those. We'll see what happens as things develop over the week ahead. Now, if you're primarily a community bank stock investor, go back to sleep. There's, it's just pretty much business as usual in that sector. A friend of mine really reviewed the community bank stocks once, and what he found was they're the last thing to go in a sustained sell-off, because A, they're illiquid. You're not selling 2,000 shares of one of these little banks to meet a margin call, because you're going to get murdered just on the bid-ask spread. So it's going to be and generally they tend to be some of the portfolio managers' favorite holdings, because they may have ties to the bank it does business, and this is particularly true on the individual investor side. Friend may be the CEO or the CFO of the bank. They may be on the board of the bank. These stocks tend to be in very tight, secure hands. So in a bear market, they are the absolute last thing to be sold. So not a lot going on there. We do not expect a lot to go on the downside of the community banks. If we get some weakness, yay us, because it's going to give us an opportunity. Some of these banks that recently have moved up from the 85 to now maybe the 95 to 100% of book value level, we're holders, but we're no longer buyers. Maybe they'll slip back down and we can once again be buyers, and that would be pretty exciting. So anyway, it's a messy market, but relax, take the dog for a walk, read a book, watch a little baseball tonight. Don't get too excited about this. We have a strategy that has worked for over 100 years, should work for the next 100 years, and we're ready for whatever happens next. So anyway, have a great evening and a great week. Subscribers will be back to you with the regular updates at the end of the week. Other than that, I will talk to you guys next week. Enjoy the week, folks.